Welcome to the Real Vision Daily Briefing. It's Friday, May 13th, 2022. I'm Warren Pies, founder and strategist at 314 Research. I'm joined today by Tony Greer. How are you doing, Tony? Friday the 13th.
Warren Eskimo Pies, I'm happy to be here, man. It's good to do the briefing on a Friday so we can sort of encapsulate the week's action, right?
Yeah, absolutely. Looking forward to getting your thoughts. Haven't spoken for a few weeks. So, today was kind of, somewhat of a bounce for the markets. We saw yields go up today, but on the week down. Sectors, kind of the most beaten up sectors leading the way today, tech and consumer discretionary, the leaders. When I zoom out, just before I get your take on market action, when I zoom out, I see from the beginning of April to yesterday's close about a 15% drawdown in the S&P 500, and obviously there were pockets where it was much worse. So it's been persistent downward pressure. One day does not a rally make, but there's always a question of whether this will be the beginning of a trend change, if we've gotten enough pain discounted in the prices. So what do you see? What you mentioned yields to me, if you want to start there or wherever you want to go. What did you see this week?
Yeah, I guess, Warren, the outstanding factor this week is that we got, fresh CPI data, right? We got more daisy cutters and inflation on the tape. We're at 8.3% year over year CPI, 11% year over year PPI. And with that, we had a potential reversal in the Treasury market this week, which, as you know, has been trading offered only. So with yields potentially, carving a high and, looks like they may have a sort of outside reversal, if not a reversal week, it looks like they may trend lower. And, maybe that's the move that you'd expect in, after another big CPI number where the sort of treasury market would be a buy the rally, sell the fact kind of thing. But I still see signs of the great rotation as this market, technology weighs on the tape because it's a bigger proportion of the S&P than the energy markets and the commodity markets. And this week we pretty much got a sell-off, across the board in pretty much every sector of the S&P. So it's a blood red week where there's no escape. This week we happen to have a big pullback in metals. We had a small pullback in energy of 5%, big pullback in metals of 10% in GDX. But we also had that weakness in technology that's persisted. Those just happen to be the sectors that are sort of short covering into the close today. But when I look at the S&P on a sort of weekly basis, it hasn't done anything to show me that it's reversal mode yet. Even though sentiment, I would say, is a little bit negative on the downside, it still doesn't seem like we found a bottom yet. I feel like there could be more selling due to more inflation and still potentially higher yields down the road.
Yeah, that all makes sense. And I mean, what we did for clients, just to give you how we're viewing things, is we laid out kind of a 10-factor checklist that we're looking for to get crossed off, or at least some of these things need to get crossed off before we could recommend getting back into the market. So chart that we saw like close to enough damage or bearish sentiment to get us interested here, or at least have the discussion, is what we call our dumb money indicator. We're looking at the percentage of ETF volume made up by inverse ETF flow. So we kind of call this, it's a retail type of trade. We want it to hit 60%, and honestly, going back to like 2010 when these things kind of came into the market structure, there's always been a big rally in the year following this number hitting 60%. We're at 57%, so we're within a whisker of that number. So not quite there yet, and that's kind of the story that I see, is that we're just not quite there yet across the board on any of the things we're looking at, but we've seen progress. This seemed like a week in the last couple of weeks taken together where there's been real kind of a sentiment change, and we're moving away from just a run-of-the-mill correction, and people are starting to panic a little bit, which is what you need to be at if you're going to get a tradable bottom. You see a similar kind of thing?
Yeah, we could be getting close. We've gotten that cluster of tick index extremes that I was kind of looking for prior to the damage of carving a low this week. We finally got a cluster of tick extremes bigger than minus 1,500 on the downside. We got it punctuated by nearly a 2,000, negative 2,000 tick extreme on the downside on Monday. So yeah, it looked like there was some selling that was definitely exhausted and gotten out of the way this week for sure. I'm not willing to make a bet yet that the upside is really worth chasing here, even though We know that bear market rallies are generally pretty significant. I'm kind of comfortable the way my book is positioned here, Warren. I don't feel like I need to make too many adjustments either way. And the reason that I say that is because, as you know, I'm a clocker and a hunter of the great rotation trades, as I've been calling it, where natural resources outperform technology. And when you sort of clear the smoke out this week, it was another advance of about 1% of the BCOM over the triple Q. And that's sort of the rotation that's key for me under the hood, for that to be continuing no matter what goes on in the broader market. That's helped me sticking to my guns on that trade.
Yeah, I mean, you've killed it on that trade, and it's been fun to talk to you about and watch it happen. I ran into a few people on Twitter, social media, and a few clients asking questions about. I think you're starting to see kind of just a maybe, and I think it's premature. The early stages of a reversal of this negative correlation between the oil and the markets, and so the idea is that we'll have weakening economic demand, and that's going to flow through into oil, right? And that, so we'll get, if we were to get oil down lower, it'd be because of an economic weakness or whatever, and that this is kind of what we need to look for. I think it's a fundamental misunderstanding of what's happening, though. I think that oil is moving because of supply constraints. It's not going to be responsive to the demand side this time around. And so, my honest feeling is that oil and energy actually keeps moving in the opposite direction of the broader market. Maybe that correlation, the intensity starts to dissipate a little bit, but overall, I don't see the dynamic, because we're really dealing with supply issues out of Russia, Ukraine, that are driving the ship right now across oil and energy, and also the kind of broader commodity complex.
I couldn't agree more, Warren. I've been trying to take my clients to task that are pushing back on my idea that the inflation trade, or sort of commodity inflation trade, is still in motion. They push back with a lot of ideas that are along the lines of, what about the demand destruction of stagflation? And while I can't really argue with that side of it, I can argue the supply side, like you say, and say, what's going to put oil or natural gas genie back in their bottle? Because right now the diesel market is so tight and so spare that there just is none. There's no elastic demand just yet. Everybody is still buying, cargoes of jet fuel, everything that they need to, whatever energy source that they need. So I don't know, if the supply doesn't loosen up, the price isn't going to give in. And so that's why my argument is still along the lines of, even if we do have, this economic setback in demand, I don't know that the markets are going to allow for a pullback on that at all, because I don't see how the supply is going to show up and satisfy the buyers. And maybe there'll be a small pullback, but it still leads to the energy markets being higher for longer. And this week was a perfect example. We got another bounce off of that 6.5 level in natural gas, back up to $8, and then sort of settled at 7.65. But with the attack that continues to rear its head on supply, like this week they canceled more leases in Alaska on federal land, so that's kicking the can for an oil recovery down the road significantly. And I think that's going to be the driving story once we shake out this CPI week.
Yeah, and exactly what you're describing is really creating, I think, confusing signals across the market. And so, a couple charts I think that show some of the confusion that's out there. If you're looking at just typical factors and trying to understand market stress, that the energy strength and oil and commodity strength are actually kind of tricking people, I think. So the first chart I would have Brian pull up is the spread between the high yield bond index and high yield bond X energy. That's the next one. There you go. And so that on that chart, what we've seen is like energy is overrepresented in the high yield index. And so over the last, 10 years, 8 years since really the 2014 collapse forward, you've seen energy push high yield credit spreads higher as a bigger influence. And so our calculation is that typically energy adds about 32 excess basis points to the high yield spread over treasuries. And today we're at a discount because of energy, because energy is trading so good and the outlook for oil and producers is so good. And so we're actually not seeing the stress you would typically see in the high yield credit spread space. And so I think it's maybe tricking people into a false sense of security that the real economy is stronger than it really is, but it's actually energy strength. And you can see this one other chart when we look at high yield credit spreads versus investment grade credit spreads. And so typically this is the scatter plot in here. And typically these two series trade in a pretty tight linear correlation. And what we've seen is a lot more stress in the investment grade space. And so I think that should be worrisome, as you saw kind of a negative GDP print a few weeks back for Q1, and obviously recession probability has gone up. And you and I have talked about the chances for stagflation rising. I think that this is a stagflationary signal because investment grade, it doesn't have many of the commodity producers or energy producers. You're looking at more of the core of the consumer economy, finance plus consumer stocks, and those spreads are starting to really show trouble already. So I think that when you kind of dig under the surface, the cross currents of oil and energy are kind of obscuring some of these messages and making it a difficult market for generalists to read. That kind of brings up the point for today's clip, which is what's the chances of a soft landing? And I think that's an ongoing debate. If you're going to get bullish at these levels, like we talked about, you're probably betting on a soft landing of some kind. But let's see what Alex Gurvich had to say when he sat down with Raoul Pal to talk about his outlook.
I think this is potentially the largest monetary tightening in all history.
It is.
How are you thinking?
It is very strong. And then, so I was interviewing David Rosenberg a few weeks ago, and I got a lot of good feedback from this. And generally, I'm somewhat aligned with him I tend to be at least partially aligned with him, not always perfectly, but we tend to think a lot similar. I followed him for years. And he's kind of giving it, he thinks recession, and that was before the negative print on Q1 GDP, and he thought recession was imminent. But he was giving, I think, like a 20% chance of soft landing. And honestly, I see next to zero chance of soft landing.
Yeah, I don't see components that allow that. If we take into account what's happening in China and Europe as well, the probability of a soft landing has got to be close to zero now.
Well, I'm thinking, paradoxically, I think that there is almost like a binary outcome. And the reason is because Fed took such a inflation fighting stand, which is also, with a caveat, some people think that Fed is way behind the curve, right? And some people think that Fed is still blowing bubbles because they're not raising rates at 200 basis points per meeting, right? I kind of think that is somewhat ridiculous view, but I have been ridiculously wrong in the past before myself.
So there you have it. Gurvich calling for basically a zero chance of a soft landing. Tony, what's your thoughts? You think the Fed can pull a rabbit out of its hat and navigate a soft landing here?
No, since Alex and I were on a panel at Real Vision and Del Mar together, I decided to fade everything that Alex says. No, because that's what he did to me after I gave my market view at our Real Vision presentation in Del Mar. I gave my whole worldview right there, and Alex came out right after me and said, "Yeah, I'll take the other side of pretty much everything Tony just said." So no, I don't get caught up, as you guys know, in the economic prognostication because I'm not a biologist or an economist. So I don't really know where we're heading towards recession, not recession. I like to let the bond market kind of guide me, and then I get to react. So, I think he probably makes a fair point, as it seems like the Fed's got a really difficult job right now. I just don't ever get terminally bearish on the U.S. economy. There always seems like there's some sector of the economy that's like really on fire, that's kind of holding it over somehow. And I hate betting on a recession happening anyway. So I'm playing this one down the middle, Warren.
Yeah, I hear you. It's kind of you can go in circles around that stuff for sure. So we try to be as quantifiable as possible, track our calls, and be transparent as well. So, but I still, of course, I'm a market junkie, so I get interested in that stuff. I guess a question before we get into the viewer questions I have for you is, we have probably since the last time we spoke, it shed 500 points off the S&P 500. I have some ideas we've been laying out for clients and how you get market exposure when the time comes. What are your favorite trades, just to recap? I know you've been looking for the great rotation. Is there anything specific within that or anything else that you're seeing that's popping off your screen?
Yeah, I'm going to take this opportunity to, I really like the risk reward that's presenting itself in some of the natural resources sectors that have pulled back. So the trades that I'm looking at right now are sort of, for example, XME, got beaten up pretty good this week. It looks like it was off about 8% by the time the week has been over. Big drawdown there, right into technical support, though, right into the moving average support levels where at least I think the risk reward is okay, right? Everybody's gotten terminally bearish copper in this sort of, $800 down move on the LME from 10,000 to 9,200. I see a really sturdy range bottom at 8,800, and that's my sort of Mason-Dixon line for copper. So if it's okay, I can get copper on this dip, because just as copper never broke out on the upside through 10K, I feel like it's not going to really break down much on the downside below 9K and stay in this range. So with my idea that that's going to be the case, with my idea that I want to buy aluminum on this huge pullback from the highs that it's seeing, to keep, along that line of having metals and natural resources exposure, XME just lands in my lap as a risk manager, Warren. It's one of those swings that you can't afford not to take when you can try to, make 5 to risk 1. And so with that kind of risk reward, I'm looking there, and I'm still really clocking the natural gas trade pretty hard, because there's still going to be a serious demand issue and supply issue over the winter. So, the DESGEN spread is still really blown out in natural gas, or that part of the curve. And, so I'm kind of looking at trying to pick off some of the natural gas producers on a dip, as they pull back into support. So that's it. I'm sticking to my knitting. I'm looking to buy natural resources on the dip, maintaining my shorts in the sort of interest rate sensitive areas of the market, like home builders and retail and tech. And, so far I haven't really moved my feet on that type of positioning.
Yeah, all that makes sense, especially as a trend follower. I think that taking a shot at industrial metals, with if you have a long enough time horizon, it's hard to see how that doesn't work out for you if you buy it right. For our clients, what we're starting to outline is kind of a portfolio approach, and obviously we're a little more quantitative in broad basket approach, but we're looking at quality stocks that we want to pair with energy. So energy typically doesn't make it into a quality screen, and so we're screening out the S&P 500. That's kind of the core of our what we call our full cycle trend system at 314. And so you have to manually plug your energy and your industrial metals and commodity producers into that strategy. And we're looking at a period like 2000 to 2005. I don't think it's a perfect analog, but it's similar to what's happening. So we had the end of the last tech bubble, and then the beginning of the next last secular bull market in commodities. And this kind of a strategy, I mean, S&P 500 was negative from 2000 to 05, whereas this strategy, did pretty well, double-digit returns annually. This is the kind of thing we're looking at. So, this is how we're advising our clients. The one thing you did say, which we aren't finished with our work, but I don't know, I would love to hear your thoughts on the bond market, because I think if you think that yields have topped here, what do you buy? In my mind, we haven't officially made this recommendation, but I've said it to some clients, is we're looking at home builders. I think that actually, when you go out there, you can either buy tech junk or home builders that are pretty cheap with, I think, structurally tight housing market in the United States. So if you told me for sure rates are going to be lower in the next 6-12 months, that's the play that I would pile into. What do you think? I know you're shorting them, you said.
Yeah, but I'm that's the one that I'm probably the most cautious about, the short, or sort of I keep my stop really, really tight to the markets, because I don't want to get that burned on a turn. The reason that I can, maybe see your point in home builders, because they were the sector that kind of nose dove first, as rates really got out of the gate. It was home builders down first, even before technology started getting beat up. So as they've gone down first, they've sort of consolidated quite a bit as yields have, sort of found this potential reversal pattern. So if, as we say, if this outside reversal week in yields does play out, and it certainly looks like that setup is perfect in the 30-year, we could see yields pulled back. And yeah, that would cause a short covered rally. What's good about your idea in home builders now, Warren, is that a very, very shallow short covering rally only would start pressing it up through moving averages and probably start some short covering there. So you'd have that wind at your sails.
Yeah, I'm glad to hear you're kind of on the same page. That's what we do is we do kind of like a factor analysis of home builders, and they've become a pure interest rate trade at this point in time, is what it looks like. So the market, I think it's a fundamentally strong market in the United States. I think we're undersupplied since the financial crisis, and so the market's kind of forgetting the fundamentals and just moving it on a macro rates trade right now. So I think if you spot me rates, that we're going to be good to go there.
Yes, man.
Anyways, let's move on to some. A lot of people want to get your thoughts, specifically on gold. We're getting a sell off here. What are the chances of a rally?
You're talking to a guy that just got burnt again, being long gold for inflationary reasons. I have a really bad taste in my mouth about gold, and because I hate losing money. And when I look at my line item P&L in 2022 so far, gold is at the bottom of it, right, with a negative number where I can't get it right. Playing it from the long side has been painful for me. I've tried gold and gold stocks, but enough about me. Gold is a shit inflation hedge, right? Let's just say that right now. It didn't really soar when inflation was ticking to its highs. We've got inflation ticking at its highs, and we've really got no outlet for the inflation to come back down, right? Because the Fed is behind on rates, and we've still got tight commodity markets, and gold is getting pummeled, utterly pummeled. So my view on gold is that you should probably leave it as the currency hedge locked up in your vault where it belongs and probably not on your trading pad. If you've managed to fade all of the moves that you've seen in gold, both when it rallies on inflation and sells off on, I guess a bit of stagflation story in the markets now, you're a genius and you should keep doing what you're doing. Gold for me has gone back to being something that I want in my safe so that I can sleep at night in case my currency implodes, and nothing else, Warren. It's really really disappointing that there was no follow through on the upside there, and this collapse has been just a price action disaster.
Yeah, unfortunately, I've been kind of in a similar boat. Like we were watching that 1950 level. It was trading between 1950 and 1680 for a long time. Breakout on the Russia invasion of Ukraine, and you expect it to. We had some closes over 1950. The next level would be make a new all-time high, and it kind of petered out. Now, the only thing I could say is that we've seen such dollar strength. It's kind of unreasonable to expect gold to really catch a huge rally when the dollar has been just like on fire like it has. And so, we did some analysis that actually gold's been pretty strong when you account for what's gone on with the dollar. So maybe if we get a break in the dollar rally, you can see gold start to, resume its move above 1950 and then challenge the all-time highs.
I don't think it's going to challenge anything, man. Last year, we saw the dollar rally 5%, and the Bloomberg Commodities Index was up 30%. Where was gold? Nowhere. Right.
Yep.
So, I mean, the dollar is a fair argument. I hear you, but the rest of the commodity complex is unfazed. The rest of the metals complex has largely been unfazed throughout this whole secular rally. Gold, to me, man, you're looking for trouble if you're wading into that as a trading vehicle right now.
Yeah, I mean it's a tricky one for sure. But your point is a good one, that we've had dollar strength in commodities. Certain commodities are strong anyways, and I've always kind of pushed back against the idea that the dollar and oil is really dictating oil. Oil trades way more off supply and demand, but the fact that oil is higher, and this leads to another question that we're getting here. The fact that oil is higher right now with Chinese lockdowns and dollar strength. I mean, I think if you're a generalist, you're looking at this last week for oil, and it's been kind of in a range or flat. But the truth is, under the surface, there's been a massive battle between, supply outages, demand outages, currency moves that are crazy off the charts, and we're still hanging in there. I think this is a really bullish type of week for oil, actually. What do you think?
Yeah, to that point, Warren, I think it's really important to follow what's going on in the crack spreads, right? Which is if you follow the 3-2-1 crack spread, where the refiner takes in 3 barrels of oil and spits out 2 barrels of gasoline and 1 barrel of diesel, right? That spread is blown out from about $10 to $50, and I think that's probably the big driver behind the strength in the market. The calendar spreads in crude are very sort of range bound, but holding their backwardated levels. But what's just amazing is that you've got flat price taken off to 110.5 because the product inventories continue to draw. So there's nowhere to go to get the products but to start off at the head of the spear buying WTI and cracking it. And that's why you're seeing the refiners go on a run through their old highs like this rally just got started. And it may have because it looks better for the refiners now. The situation is better for the refiners now than it was 6 months ago at 50% of the price where they are now. So we're at a really, really, huge inflection point where the refiners can just continue rallying from here just because of the tightness and the lack of supply in the products market. So it's really, really hairy situation. I think that alone is going to drive crude oil to a very, very shocking price on the upside in the near future.
Yeah, and if you think about Gulf Coast refiners, they're producing more like a 2-1-1 crack spread. So they're like 50% diesel, so even more money, given that the fact, or middle distillates, I should say, to be more accurate. So they're making even more money down on the Gulf Coast where we have so many independent refiners like Valero and Phillips, and Marathon has some facilities there too. So I mean, yeah, I think refiners are in good shape for sure. I mean, crack spreads are crazy high. I like the integrateds also because I think there's going to be just an uplift across the board, whether you're talking about crude or refined product. There's some room for that spread to narrow, I think, and so you kind of want to. The integrateds are back in the driver's seat right now. But you can almost throw a dart in the energy space, I think, at the moment, to be honest.
I agree.
Kind of out off the beaten path, but a question for you about cannabis stocks and MSOS. This is an area I have really no thoughts on, but it's directed towards you. What do you think?
You can't touch them with a 10-foot pole, unfortunately, right? I mean, I'm a momentum guy, as you know, Warren, and they have shown no signs of picking their head up. When they've shown the most modest sign of picking their head up technically and challenging a moving average, it's like whack-a-mole, and they're making a new low. I just commented to some guys in my Slack channel, like they're still carrying out generals in the cannabis market down here. You know what I mean? As in, like firms like Aurora Cannabis and Canopy are legging lower in large magnitude moves to new low prices that they have never seen before. That to me, as bullish as I can get the space and as excited as I can get about the valuation that we're trading, three and four times forward earnings. I can't step in there and buy any of this until the market decides it's found a level that it's willing to pay for cannabis. But right now, I mean, you can't give these stocks away if you walk into a reggae concert with the certificates in your hand. So I'm gonna take a pass right now.
Man, yeah, that sounds about right. Probably last question, just it's a great one to end it on, I think, for you is to Tony. Do you see the market hitting all-time highs this year or the early part of next year? And if yes, then what do you think will be the catalyst to drive the market up? Because everyone is bearish, so isn't that contrarian? So I mean, it's just kind of like a nice little bow to wrap this conversation up. What do you think? All-time highs in the next 12 months?
No shot. I think no shot. I think that if you study the Nasdaq and study sort of Nasdaq history, you learn that all of these stocks have the same storyline over a different period of time, or in a different sector in a different shape. And when I look at the Nasdaq chart now, I feel like we're witnessing something that is actually breaking for really good reasons at a massive, massive inflection point in both history and markets. So with that combination, I just think that this commodity inflation, supply chain issues, and the need for portfolio managers to cling to hard assets in the markets and the move away from, as you can see, electronic bits in the sky like cryptocurrency and software and internet stocks and all those sectors that are still the worst performers on the year. Those are still in bear market territory right now. The Nasdaq is off 20 something percent year to date. it's dangling at a new low, even though there's been a little tiny bounce off the low of the move. Broadly speaking, I think that is one-way traffic for the rest of the year, right? We shot three generals. We shot Facebook, Netflix, Amazon. We just had a huge trend line break in Apple. Apple had a 5% down day this week for the first time in 2 years. I mean, they are showing signs of erosion. And I think with the leadership that's that massive a part of the equity indices getting really technically beat up and removed from its bullish trend, I do not think that we're going to see a new high in the Nasdaq this year, because that's my big bearish sector, and I don't think that the S&P can obviously rally if big tech is going to go down. So the only shot that we have is for natural resources to be incredibly strong and provide some kind of counterbalance. Otherwise, we're going to have a serious selling pressure before the end of the year at some point. So I'm a little bit bearish. I understand that it's a contrarian call, but until somebody can show me what's going to push inflation down, I can't really adjust my sales right now because everything looks good.
Yeah, I mean, I think that's a good guideline for the year. My 2 cents is, it's when you kind of get a little closer to what's happening right now. One of the reasons why I'm not in a huge hurry to go out and buy the market, even though we saw, 38 something yesterday at the lows, is that, you need enough meat on the bones to get that next kind of bear market rally and have it be meaningful to you. Because if we bounce up to 4,400 here, only thing you get is a signal to Jerome Powell that basically you can keep moving aggressively against these markets. So I think the rallies at this point are kind of self-defeating. And so if you get, maybe we get back to 4,400 on a bear market rally, it's like, so what? Do you want to buy the market up there? I mean, why? It doesn't make a lot of sense to me yet. And we're going to need something else. I think that something else will be a reversal, of course, from the Federal Reserve, and we are not there yet. I also think you need to get behind the midterm elections, probably, to be honest. So
that's a great read, Warren. I like it.
Awesome. On the same page. Well, I appreciate it. It was good talking to you again. It's been a couple of weeks. And tomorrow or Monday, Eric Johnston will be here. So thanks again to everybody out there for watching the Real Vision Daily Briefing. Warren Pies with Tony Greer.
Great job, Warren. Have a good weekend, gang.
You too, man.
Be good.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion, but who's right, who's wrong? As co-founder of Real Vision, I've got my own view, but maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen my experts for this 2-week journey of discovery in global recession. Is everyone wrong? I've chosen people like Peter Zeihan to talk to him about geopolitics, David Rosenberg about the economy, and Pierre Andran, the world's most famous energy trader, about how to navigate the oil markets and where it's all going. This starts on May the 2nd. And I'm going to learn so much about what really is going on and how to best navigate it. Yes, not everybody's going to be saying the same thing, but it's going to allow me to piece together an investment framework to navigate these complicated times. Now, normally we'd give you a 7-day trial for $1, but because this is so important for all of you, and I think it's one of the most important pieces of content we've ever done, we're extending that free trial for 2 weeks for $1. So you get the entire campaign of all of these great minds. And it's only $1 for all of this. So just go to realvision.com/global recession to find out more and join me as I try and figure out what the hell's going on.